let's go in and take a look at the balance sheet. And the first step is the balance sheet analysis. In the balance sheet analysis, there's important pieces of information here. And I'll go into what's behind the numbers. But the key pieces of information here, there's the funding ratio. So right now, all necessary goals are funded. But with a margin of safety of 9%, that's a very low margin of safety. What that means is that this blue bar of resources can only fall by 9% and still meet the necessary goals, fully fund the necessary goals in this dark brown structure. So across our retirement funding and our education, the necessary amounts are just barely fully funded. So in investment planning, what this means is that your investment strategy can't have such risk that it would incur losses over 9% and put these necessary goals at risk. So you're going to see a very conservative portfolio as a result of this. And I'll play around with it to illustrate how risk capacity comes into play here. What's behind the numbers is present value analysis on the balance sheet. So this is just at a single point in time, conservatively looking at the households, comparing the household's resources with future commitments on those resources. And what it's doing is it's looking at the current liquidation value of your resources with the current defeasance cost of your commitments. What's defeasance cost? Well, in simplistic terms, it's the equivalent if you were to purchase an annuity just to write away all your commitments, you know, what that cost would be in simplistic terms. So commitments are done are calculated with present value analysis, but different discount rates are used. So the discount rate used in the present value analysis of your necessary goals, necessary priority class for goals, the discount rate is a very conservative discount rate that's akin to an expected return of a very conservative portfolio that you might fund necessary goals with. Right now, that's about 4%. For a target amount, the discount rate that's used in the present value analysis here is equivalent to the expected return of a more balanced portfolio. Right now, it's a little over 6%. And the discount rate used for aspirational goals is equivalent to the expected return that one might see on a more equity-oriented portfolio, just under 8%. So those discount rates are used for each of these priority classes, and for things like retirement expenses, we use actuarial present value analysis, so it calculates them to life expectancy and includes gender-specific mortality rates. On the resource side, the liquidation value of resources, first there's investment accounts. Currently, these were entered at the asset class level, so there's no notion of capital gains. That will be in there, obviously, when we get down to the holdings level. So the only haircut that's being received on the investment account is a 1% commission on liquidating the account, because what was indicated is they weren't in cash, they were in actual securities. So there's a 1% haircut to liquidate this account. On the retirement account side, there's the haircut for commissions. Then there's the big haircut for taxes. We had a very high tax rate of 50%. Remember, this was $1 million represented in this account. So its liquidation value is just under $400,000. Very conservative approach. So taxes are taken into consideration, as well as this individual is below age 59 and a half. So even though they may hold these assets until retirement, currently looking at the balance sheet today, we incorporate the 10% early withdrawal penalty as part of the haircut as well. So it's a very conservative view of the household balance sheet.